I'm presenting a crisis regime asset allocation strategy, a systematic approach to equity selection during major market dislocations like global financial crisis and COVID-19. The core idea is very simple. During crisis, I focus on small and medium cap stocks that are cheap on fundamentals, have controlled volatility, and exhibit low sample entropy, meaning that their price patterns are more structured and predictable. Why should this combination work? Small and mid caps offer greater return dispersion than large caps, creating room for alpha selection. Value stocks tend to be oversold in crisis and recover strongly. Low volatility names avoid the worst tail risk, and low entropy stocks, those with more directional, less chaotic price behavior, tend to deliver better forward returns when markets are stressed. Together, these filters identify names that are mispriced, stable, and structurally predictable precisely when those qualities matter most. Let's start with the headline results. During the global financial crisis recovery, this strategy delivered approximately 71% cumulative return versus 47% for the Russell 2000, at slightly lower volatility and with virtually identical maximum drawdown. The Sharpe ratio of 2.46 is substantially higher than the benchmark's 1.73. With beta below 1 and alpha around 21%, the strategy captures more upside per unit of market risk. The COVID-19 picture is different, but equally compelling. The benchmark returned around 46% versus 30% of the strategy, reflecting an aggressive beta-driven rally. However, the benchmark's path is far more volatile, with drawdowns lasting nearly 3 times as long. The strategy achieves a higher Sharpe ratio of 2 versus 1.75 despite the lower headline return by running at roughly half the volatility. When I rescale the strategy returns to match the benchmark's volatility, the performance gap narrows substantially. At equal risk, the strategy delivers a competitive payoff with fewer and shorter drawdowns. This confirms that the COVID underperformance is about taking less risk, not weaker selection. On a risk-adjusted basis, the strategy remains superior. So let's take a look at the investable universe. So we have a set of almost 3,000 US stocks, out of which we select small and medium capitalization stocks. I exclude microcaps due to illiquidity and noisy pricing, and I avoid large caps because they are more efficiently priced with less cross-sectional dispersion. The small and mid-cap segment offers more opportunity for stock-specific alpha. On the fundamental side, I classify stocks using a value score and a growth score. The value score captures how cheap a stock is, a metric like price to book and price to earnings. The growth score captures how much investors pay for future expansion. I combine this into a net style score, which is a growth style score minus value style score. It gives me a single measure of whether each stock sits on the value to growth spectrum. For this strategy, I focus on stocks that are tilted towards value. Knowing a stock's current net style score tells you where it sits today on the value to growth spectrum, but that's a static snapshot. What I really want to know is where it is heading. Therefore, I regress each stock's net style score against time and extract 2 statistics, the slope and the R-squared. The slope tells me the direction and the speed of style drift. A negative slope means the stock is becoming more value-like over time. Its valuation multiples are compressing or its growth premium is fading. In crisis environments, stocks drifting towards value are often those being priced by the market as expectations reset. These are the names most likely to benefit when sentiment recovers. But direction alone isn't enough. A stock might have a negative slope simply because its net style score jumped around randomly and happened to end lower than it started. That's noise, not a signal. This is where R-squared comes in. R-squared measures how well the linear trend fits the actual data. In other words, how consistent the drift has been. A high R-squared means the stock movements towards value has been steady and directional, not erratic. A low R-squared means the trend is unreliable. For the strategy, I require both a negative slope, the stock is drifting towards value, and a high R-squared, typically above 0.5, meaning the drift is persistent rather than noisy. Together, these filters identify stocks with sustained momentum towards value characteristics that I assume should outperform in crisis recovery phases when cheap overlooked names get re-rated by the market. On the non-fundamental side, I use two key features: sample entropy and rolling volatility. Sample entropy measures how often similar return patterns repeat. Low entropy means more regularity and predictability. High entropy means more randomness. Importantly, entropy captures something different from volatility. They are not the same signal. During crisis, volatility spikes sharply, but entropy compresses. Markets move violently, but in more one-sided directional ways. Persistent sell-offs followed by persistent recoveries. This creates a state where low entropy stocks outperform. Lower sample entropy doesn't imply that the stock is safe. During crisis, volatility spikes sharply, but entropy compresses. Market moves violently, but in more one-sided directional ways. From the correlations, we can see that during crisis, volatility and entropy are negatively correlated. When volatility spikes, entropy compresses. The same can be seen on the box plot. Moving from lowest volatility to highest volatility, median sample entropy systematically declines, with the effect especially pronounced during crisis episodes. It can be seen here and here. Looking at sample entropy and forward returns relationship, we can see that the correlation between sample entropy and forward returns is strongly regime dependent, with strong negative correlations during the crisis periods. Lower entropy means higher expected returns in the future. The box plot shows similar results. There is a clear negative relationship during the crisis when lower entropy predicts higher forward returns. It also can be observed during GFC as well as COVID. The correlation between volatility and forward returns is strongly regime dependent as well. We see that correlation spikes during GFC and COVID. Past volatility has little systematic relationship with forward returns in normal times, but relationship is meaningfully positive during crisis regimes. This is consistent with the risk premium or mean reversion dynamics when markets are under stress. With all features covered, let's review strategy design. The strategy follows a four-step process. First, filter for small and medium capitalization stocks. Second, filter for value stocks with stable, improving trends. Third, keep only those in the lowest volatility quantiles. Then, rank the sample entropy and select the 10 lowest entropy names. The portfolio is then equally weighted. For entry time, I use the cross-sectional average of sample entropy across small and mid caps. When entropy turns up from extremely compressed crisis levels, that's the signal to enter. So for the GFC, that's the date of the 30th of April 2009, and for the COVID, I choose 31st of August 2020. The results are compelling. In the GFC, the strategy returned 71 versus 37% for the benchmark, with slightly lower volatility and a Sharpe ratio of 2.46 versus 1.73. During COVID, headline returns was lower, 30 versus 46%, but at roughly half the volatility and with a higher Sharpe ratio. The strategy functions as a low beta allocation that prioritizes risk-adjusted returns over raw performance. The strategy is clearly preferable to the benchmark in GFC regime and functions as a capital preservation allocation rather than a return maximizing strategy during COVID-19. It remains superior for risk-adjusted returns. As a counterexample, I tested a simpler strategy that used only value and low volatility filters without sample entropy ranking. This helps isolate how much value the entropy layer adds. During the GFC, the low volatility strategy delivered similar performance to the benchmark, around 44% versus 47% for the Russell 2000. It ran at lower volatility and achieved marginally higher Sharpe and Sortino ratios. But crucially, it doesn't generate the strong outperformance seen in the entropy-enhanced strategy, which returned 71%. Beta was 0.79 and alpha just 6%, indicating a defensive, quality-oriented profile that participates in recovery but doesn't fully capture the strongest repricing. Behaves as a very defensive low beta portfolio. It ran at roughly half the benchmark's volatility, 12 versus 23%, with smaller drawdowns and materially lower tail risk. However, it also captured much less upside. Cumulative returns were just around 21% versus 46% for the benchmark and 30% for the optimal strategy. Sharpe and Sortino ratios are actually worse than the benchmark. This pattern reflects the fast, beta-driven nature of COVID-19 rally, which structurally disadvantages low volatility portfolios. The low volatility strategy improves some risk metrics, but doesn't generate the same outperformance as the full entropy and value-aware design, especially during the GFC. This confirms that the edge comes from combining value, volatility, and sample entropy. Low volatility alone is not enough. I would like to conclude with 3 key takeaways. First, use net style scores with negative slope and high R-square to identify stocks drifting consistently towards value. Second, sample entropy provides information orthogonal to volatility with strong predictive power for forward returns, specifically during crisis regimes. And third, crisis periods exhibit simultaneously elevated volatility and compressed entropy. Prices move violently but along more directional paths. Exploiting this structure is the source of the strategy's alpha.